Let's understand what is the forward contract in this reel within this 90 seconds. Let's try to understand that one clearly. So let's say I am a coffee shop owner and you are a farmer who grows coffee bean in your farm, and I need 2000 tons. Let's say for example I need 2000 tons of coffee beans on December 20 from today, 6 months from today, December 20. And I come to you and I will say I want to buy 2000 tons of coffee beans on December 20. And let's consider the current open market price of coffee is trading around $2 on the open market, $2 per ton for example. And we both agree saying that you will deliver me the coffee beans on December 20. Let's say we agreed upon a price which is 10 cents above the current open market price. So that is $2.10. So we both agreed that I am gonna pay you $2.10 per ton, and that will be around $4,100 for total sum. And you will receive that on the December 20, and you gonna supply me the 2000 tons of coffee beans to me on December 20. So this is the complete contract which happened between us. So we are the two parties and we came over the counter. So this complete action is called, this complete agreement, this complete thing is happened offline. So we can say that this is OTC, which is called over the counter. So this agreement is known as over the counter agreement, and this is a forward contract, and it's highly customizable according to our needs, according to the both parties needs and requirements. It's highly customizable. And let's skip it to the delivery date. So this is a delivery date, right? So December 20 is the delivery date, and let's say after 6 months there can be two scenarios. So the first scenario is, let's say on December 20 the price of the coffee bean has dropped drastically to $1. So no matter what happens, the farmer should supply the coffee beans to the coffee shop owner, and the coffee shop owner, no matter what the open market price is at the time of delivery, he needs to pay the money which has been agreed on the contract. So now what happens, the price has been drastically came down, so dropped, right? So in this case the coffee shop owner has to buy it at the same price at 2.10, even though the price of it has been dropped. He has to buy at a premium price. Okay, so this is a loss for a coffee shop owner, but it's a profit for a farmer considering the current considering the price which is going on the delivery date, right? And let's say in second scenario the price has been on a rally. Let's say the price has been on a rally to the upside, and the price is $3 on December 20. Let's take that one. So now even though the price has been increased, he should supply the agreed tons, that is which is 2000 tons. He has to sell that, he has to supply the 2000 tons at $2.10 according to the agreement. Even though the price has been increased, he has to sell it for $2.10 only. So now in this scenario the farmer made a loss considering the prices on the open market, but the coffee shop owner made actually a profit considering the prices on December 20. Okay, so these are the two scenarios. Actually the main drawback of this contract is rates of default. the risk of default is high here, because either of two parties can say no, I don't want to do this, the price, etc., giving any reason, maybe a bankruptcy reason or maybe some other reason, they will not fulfill the agreement. Yeah, so the default risk is high. But yeah, they can, let's say any either two parties can say no, but the other party can go to the court and file a case, and the case goes on. For he can sue the company, or the company can sue the farmer for breaching the contract, but that's a long process. But still, it happens on the over the counter. Let's sum up the video. So what is a forward contract? It's a contract which has been traded OTC, which will be traded OTC, over the counter, which happens over the counter, and it's highly customizable, highly probe to the risk of default, and it cannot be exercised. Actually, it cannot be exercised before the delivery date, because if you want to, if let's say the farmer wants to exercise the contract, the coffee shop owner should be ready to exercise too, otherwise it does not happen. So the liquidity, you can say, the liquidity is less, and the option to exercise the contract anytime is also not there when compared to the futures contract. So yeah, he can only exercise the contract, I mean he can only exercise the contract on the delivery date, that's it, on the maturity date. That's why we say maturity date. Neither of two parties can't exercise the contract. So that's sum up of this uh, video. And actually there is a lot of things to say about forward contracts, but this is a short understanding of a forward contract. Please follow us and share this video, and we will make another video on futures contract, and then we have another video on how these two things compare to each other. So please watch those two, and bye guys, see you.